Hello friends, welcome to the September edition of Monthly Viewpoints. The month of August saw us in the midst of an earnings season. We have seen robust financial performance from Indian corporates in the first quarter. Almost two-thirds of the Nifty 50 companies reported earnings that were either in line with or above consensus estimates. Consequently, both the Nifty and the Sensex rose more than 3 percentage points and attained lifetime highs in August. Now, excluding the corporate banks which missed earnings on account of higher provisioning and will likely need some more time to stabilize, the Nifty sales grew by 24% year over year, EBITDA by 19% and adjusted PAT by 27% year over year. A point to note is that the numbers may seem high on account of the base effect, but even adjusting for that, growth was quite strong. Consumption-oriented sectors such as FMCG, consumer durables, domestic autos, private banks and NBFCs reported strong earnings, while export-oriented sectors such as IT also performed well. While on the one hand the Indian corporates have been gaining traction, on the other hand the global macro backdrop for India turned cloudy in August on the back of higher oil prices and the depreciating rupee. For the last 3 months we have been reiterating how critical it is for oil prices to remain in the $55 to $65 per barrel range to have a stable macroeconomic environment in India. However, in August, crude prices rallied almost 10% due to lower supply and averaged around $74 to a barrel. Consequently, India's trade deficit surged to an all-time 5-year high of $18 billion and the CAD also widened to 2.4% of GDP. We also saw that in response to increasing inflation, the RBI also raised rates by 25 basis points. Overall, we remain watchful as oil prices are above our comfort zone. In addition, the US dollar also gained strength in August. The US GDP data has come out quite strong and has boosted odds of further rate hikes by the US Fed. The fact that this will lead to continuing strength of the dollar is weighing in on emerging market currencies. The Indian rupee depreciated more than 3% in August. Year to date, it has depreciated almost 13% and also breached the levels of 72 rupees to a dollar for the first time. We think that the rupee will continue to have a depreciating bias and hence investors should recalibrate their portfolios accordingly. Amongst emerging markets, Turkey and Argentina have been gaining attention as their currencies have depreciated almost 20% and 30% respectively over the past month due to stubbornly high inflation. The Turkish central bank has indicated that it will adjust its monetary policy and target price stability. Argentina has already raised its benchmark interest rate to 60%, entered into an austerity program and is being bailed out by a $50 billion loan from the IMF. The risk of contagion from these two countries is low as they have very limited trade linkages with other countries. On the trade front, the US is poised to impose tariffs of almost 25% on $200 billion of Chinese goods. If the US does so, Beijing has threatened to retaliate appropriately. In such a scenario, the impact is on around 6% of global trade. We continue to monitor these developments as further escalations in the trade war can start impacting global growth. Coming to our view on the equity markets, in US dollar terms, the Indian market continues to be amongst the best performing markets globally, despite the macro concerns. We have seen that the large cap indices attained lifetime highs in August and the market breadth also improved with the mid caps outperforming large cap indices in August. If we look at the valuations, on a trailing basis, the market valuations are still on the higher side and any upside in the near term is likely to be capped. The markets are likely to consolidate in the short term and global volatility may even lead to a minor correction. However, given that earnings growth is supporting the markets, investors are advised to continue the exposure to equities in the long term and buy into any corrections, if any. While we have had a large cap bias for most of last year, we would advise investors to allocate around 20% of their corpus to mid-cap funds. Valuations in that space have become reasonable and we remain constructive on overall economic growth. Coming to the sectoral outlook. With the ongoing rupee depreciation, export-oriented sectors such as IT should benefit. We remain constructive on the consumer discretionary space with sectors such as autos, small appliances and white goods. On the private sector banks, we continue to believe that increase in their market share will be a secular trend over the next decade. Apart from the retail banks that we have been overweight on for a long time now, we think that the private corporate banks also look good as a majority of the asset recognition pain is already factored in the stock price and a recovery is in the offing. We are also positive on rural-oriented NBFCs as they are leading from the front in terms of providing higher access to credit, especially in areas where the banking platforms are yet to materialize. We offer a basket of suitable funds for investors to choose from. Coming to the debt market view, we recommend that investors stick to credit and accrual funds as they will give lower volatility and higher yields in the current environment. Thank you and happy investing.